Hey everyone, this is Jason Martin from AllGen Financial Advisors. Today is February 24th, 2022, and I just wanted to give everyone an update with the recent market volatility and what's going on in the markets, especially as it has to do with the Russia-Ukraine conflict, and kind of give some historical context around that. Also, kind of look at market returns and what happens after high fear events like we're in right now, and then kind of look at the difference between the market returns of last year, or even for that matter, last few years, compared to the market returns going into this year and kind of what to expect going forward. And finally, I wanted to touch on bond returns after the first rate hike, as we're starting to go into rate hikes most likely this year. So let's hop right in. So first of all, with the Russian-Ukraine conflict, one thing that's really important to keep into context and to understand is that in terms of the economy, in terms of the effect on the stock market, Russia, just to kind of give you some context here, only makes up 3% of emerging markets. So the main emerging market index is called the MSCI Emerging Markets Index. It only makes up 3% of that of emerging markets. It only makes up 0.4% of the all country world index, which would include US and other international countries. So, that's really important to know. And also, Ukraine's not even on the chart. There's like almost 0%. But, you know, I'm not trying to not be sensitive with what's going on with the conflict, but from the standpoint of how it affects markets in general, it's important to know that the economies are not very big, and especially the stock markets in general are not very big compared to the overall global economy. So it's also important to know like what has happened in the past during major kind of world events, and I list a few here that I thought that were most kind of relevant. And let's just go down the path first of all. Like if this ends up being World War III, and by the way, I don't think there's like 0.0001% chance that that will happen. But sometimes it's important to like go down that worst case scenario. So if you're comfortable with that and you see what's going on there, it'll help you get through the events that are currently happening. So looking here at this chart, if you see the Germany invading France in 1940, that was the start of World War II. And you can see, obviously, the first month of the market, it was down 20%. And even 12 months later, really after that first month, it actually was up after that first month over the next 12 months. But as a whole, even 12 months after it initially started, down 18.7%. Now, look at this next one here. When Pearl Harbor was attacked, so when the U.S. entered, basically when we entered World War II, 12 months later, after the Pearl Harbor attack, the market was actually up 4.3%. So you can see a lot of different ones here. The North Korea invades South Korea. After initial shock, the markets were up in the next 3, 6, and 12 months. Cuban Missile Crisis, it was up the entire time. The Six-Day Israel-Arab War was up that whole time. Iraq invading Kuwait initially had some market volatility, but then 1 year later was down 10%. And what was probably the biggest one in U.S. soil outside of Pearl Harbor attacks was the U.S. terror attack, September 11th, 2001. You see, 1 month later, the market was actually flat. In fact, 3 months later, it was positive. 6 months later, it was still positive, 6.7%. And really, over the next 12 months from when when those terrorist attacks happened, that's really more of the tech bubble that was popping during that time than it was necessarily the terrorist attacks. So, the market, after one of the biggest events, in U.S. history, the terrorist attacks, the market was positive 3 months and 6 months later. The Iraq War that started after that in 2003, market was positive the whole time. And then actually, in 2014, Russia invaded Crimea and annexed Crimea, and the markets were positive during that time, 1 month, 3 months, 6 months, and 12 months later. So it's important to understand those things to help give it some historical context. Also, if we look at, this is the S&P 500 going back all the way to the 1920s. The red vertical lines mark some of those events that we just talked about. You can see this is Germany invading France right here, where the market did initially drop over that next year, the start of World War II. But when the Pearl Harbor attacks happened, the market went up significantly after that. In fact, that war was very good for the stock market. Obviously, there was a lot of death, and I'm not talking about it from that standpoint, but from the standpoint of the stock market, it created a lot of manufacturing, and it really got the economy going. And you can see some of the other events too. North Korea, the Cuban Missile Crisis, it was up afterwards. Six-Day War was up for the next year. Iraq, so all of these charts will show that the markets can shrug off some of these events, especially these more minor events like the ones that's happening now, and even the major ones like the World War II. It is able to get past that over time. You understand, if we did go into a major war, which again I'm saying that there is very, very little chance of that. In fact, Europe has not said that's out of the cards. The U.S. has basically said that's out of the cards. So there's a very small chance that will happen. But even if they did, it creates a lot of manufacturing, and the Federal Reserve and central banks tend to be very accommodative to help the economy keep going during that time. So you have to keep those types of things in perspective, other than just the fear that you see on the news. So let's look, another point that's been brought up. Well, what about oil prices? If oil prices go up, and that's going to make inflation worse, and so you get a lot of those. That's another kind of headline that's coming from this. Well, it's actually been very encouraging to see over the last decade, really. And the chart that we're looking at here, what it's showing is U.S. petroleum consumption, and I'm really focused most on consumption and production. The blue line here is consumption, and this brown line here is production. And as you can see over the last year, in fact, in 2020, the United States produced 18.4 million barrels, and we consumed 18.12 million barrels. So we actually produced more than we consumed. With all the different types of new technology in order to help extract oil from the ground, the United States it's become the largest oil producer in the world. And so, from the standpoint of that really gives us a kind of a protection, if you will, maybe a firewall is what you could call it. It protects us against major oil events. So, if you look 10 years ago or even 20 years ago, back in 2000, in 2003, when we invaded Iraq, when we went into the war with Iraq, you can see that the difference between the consumption, the blue line, and the production down here was a big difference. So anything that happened in the Middle East or with any of the major oil producers, that would cause a big issue because we imported a lot of our oil. Well, imports, being this green line, have significantly gone down, and actually you can see exports have gone up. So if it came to a really bad situation, we actually produce in the U.S. enough oil to sustain our consumption as of now. So there's the oil, there's not this major risk of an oil shock and oil prices shooting up as high as they did 10, 20, 30 years ago when those types of conflicts happened. So, all right, shifting gears and looking here at some of the major index returns for the last 12 months. And when I say major indexes, what I'm referring to is not what you hear about in the news, the NASDAQ, the Dow. We are going to talk about the S&P 500, but the NASDAQ, Dow, and S&P 500 are very similar. They're mostly large U.S. stocks, with the NASDAQ being more focused on technology. But I'm looking at the major components that make up a truly diversified portfolio. So, and I'm using some different funds to represent, like the S&P 500. We're using the Vanguard 500. It's almost identical returns to the S&P 500, S&P 600 total return. And so you got your large caps, the S&P 500, the S&P 600 is small caps. And then you got the Bloomberg U.S. Aggregate Bond Fund, which represents bonds. And then you got the FTSE All World ex-US, which represents international emerging markets. So if we were to look back over the last 12 months, the only one of those that is positive is the S&P 500. And you can see really this goes back exactly 12 months, but up until pretty much the end of the year, that market was really the large U.S. stocks were doing really well, and some of these other areas, even small caps, weren't doing as well. They were positive, but they weren't doing as well. International was slightly positive, not doing as well. Bonds were going down during that time. So that's what it looked like over the last 12 months. Now, a lot of people have become so used to markets doing so well really over the last 5 years. We've only had one bad year in 2018, and a lot of these other returns, S&P last year for 2021 doing 28%. It's been in the 20s a lot of times in the last 5 years, and people have become accustomed to that. But that is not the normal. And so when people become accustomed to those huge returns, they expect them every year, but that's just not what happens in the markets. You have good years and you have bad years, and averages over the long term are closer to like 8 or 9, 10%, not 20 every year. So, it's tough when you kind of transition from a really strong market into a little bit more of a rocky market. But at the same time, it's just part of what markets do. They have strong runs, and then they kind of consolidate and they take a breather, and then they have strong runs again. So we're kind of in that consolidation phase right now. But if we flip forward, well, before we flip forward, some people ask me at times, clients and other people, why, since the S&P 500 has done so well, why don't we just put everything in the S&P 500? It's just done so much better than everything else. Well, if we were to do that, it wouldn't be a very diversified portfolio. You'd only have large U.S. stocks. And yes, the S&P 500 has done extremely well compared to those other major indexes over the last 10 years. But the prior 10 years, that wasn't the case. International did way better. Small caps did way better. And there's even been times, actually, even from 2000, 2010, bonds did way better than the S&P 500. So if you were to only be in the S&P 500, you would be in the area that's returned the best over the last 10 years. But usually what happens is that reverses and kind of flips over the next 10 years. So let's now look at the same indexes for just this year to date. Almost exactly the opposite. The worst return was the best return from the last 12 months. So the S&P 500, and this is as of the 23rd's close, February 23rd, but it's down 11%. Small caps are down 10%. You have bonds down 4.7%. And then the one that's actually held up the best, bonds have held up the best. And then you have international right next to it at 4.7%. So what did the worst last year did the best this year. What did the best last year did the worst so far this year. And that's not an anomaly. That tends to happen a lot over time. So that's why it's important to really be diversified and hold all different types of areas: large U.S. stocks, small U.S. stocks, international, and emerging markets, bonds. That's really a diversified portfolio. Just holding large U.S. stocks is not a diversified portfolio, and it doesn't always outperform, even though it has over the last 10 years. I can show you multiple time frames where it's really underperformed these other ones. All right. So, one thing that we've been talking about where we see the opportunity over the next 5-10 years and where we see better valuation is emerging markets. And emerging markets last year didn't do as that well, and especially compared to the S&P 500. But take a look this year. Year to date, emerging markets are down 2.83%, with the S&P down 11%. So what a lot of times is considered a very volatile area has actually held up better than what would be considered less volatile historically in the U.S. stock market. So that's something that we've been slowly getting into more and more over time, as we believe there's good value there. It doesn't always play out exactly when we want it to. Sometimes it may take another year or two beyond when we first started getting in that position. But that's why anytime we make a move, we usually do it slowly over time instead of going all in into one position. So just wanted to point that out because that's an area that not only typically does better in an inflationary environment that we're in, but it's also a good valuation compared to the S&P 500. And historically, when valuations have been much better, they've outperformed U.S. stocks. So another thing that we've been invested in is commodities. So looking at commodities year to date, you can see here this orange line. Commodities have actually gone up 14% this year. This is just an ETF that tracks a main commodity index, and it's up 14% while the S&P is down 11%. So that's something that typically does well in an inflationary environment. It's something that our clients have been invested in for a while, and not this exact security, but commodities in general. And it's something that, if inflation continues, this is something that we'll have in the portfolio that should protect our clients from more inflation. So, changing gears again to now looking at what happens in high fear environments. And when I use the word fear, I'm specifically speaking of the volatility index, also known as the VIX. In the VIX, without getting into all the mechanics of how it works, but essentially what it shows you is when the blue line, which represents the VIX down here, goes up, and especially when it gets above 30, and really an extreme would be 40. And we're actually measuring it here when it gets above 36. What happens over the next few months, year? What happens in the future? And historically, whenever there's been a large amount of fear, the future returns of the market have been pretty good. And so today, and actually a couple of weeks ago, the VIX got above that 36 number 2 times. So in the past, when fear has been high, with the VIX going above 36, these have been the future returns. And you can see here, 1 year later, when the VIX has gone above 36, which it did that today, the market has been positive 94% of the time, and the average return has been 25%. And even in the next 6 months, every time that's happened, its market's been up 84% of the time, with an average return, not an annualized return, just a 6-month return of 13%. So the win rate, or the probability, or the past times when the market has been positive, is not as certain in the next few weeks and month, or over the next 1 week, 2 week, and 1 month, but it becomes a lot more certain as you get out further into the future. So while it may go against everything inside of you, usually the best times to add money to your portfolio is in these very high fear environments. And that tends to create an opportunity, even though it is probably the scariest time to invest. Usually that's the better time to invest. At least historically, that's been the case. Obviously, there's no guarantee of future returns. All right, now switching gears one last time. The last topic I want to cover is bonds. A lot of times people, especially recently, people are asking me, why would I even hold bonds? Interest rates are going to go up. The Federal Reserve is going to start raising interest rates. Why would we hold bonds in that type of environment? And just kind of bonds 101, the conventional wisdom on bonds is when interest rates go up, like when the Federal Reserve starts raising interest rates, bond prices start going down. So it's an inverse relationship. So in general, is the case. However, the timing of when that happens is not always the way people believe. And so any market, whether it be the stock market, the bond market, it is very much forward looking. It's anticipating the future. Okay, the smarter money, the bigger money out there is already anticipating what's most likely to happen. Very similar to kind of why the market started to pull back prior to the attack actually happening from Russia and Ukraine. And now, actually, as it's closed today, when Russia actually attacked Ukraine and sent missiles and attacked military sites, the market actually ended up positive. So it went down a lot going into the event, but when the event actually happened, it went positive. And that's the market anticipating the future. The people in the know, the military experts, the people that have access to a lot of information, are already anticipating that Russia will invade Ukraine, just with the troop buildup, and so they start placing their bets. So I'm just giving you an example of how the market anticipates the future. Now, looking at the bond market here, we're looking at long-term U.S. Treasury bonds, and it's represented by the Vanguard Long-Term Treasury Fund. Okay, so this is the most interest rate sensitive meaning if interest rates were to go up, typically this would go down the most. And so the Vanguard long-term Treasury bond index, again, very highly interest rate sensitive. Now, what we're looking at here is the blue line is the first rate hike. Okay, so right now, let me set this up a little bit. We're going into a rising interest rate environment. And so the Federal Reserve will most likely raise interest rates coming in the next Federal Reserve meeting, which is March 16th. So it's about 3 weeks from now. And so again, a lot of people think that bonds will go down because they're going to start raising interest rates. Well, here's what historically has happened. So in June 30th, 1999, when you had the first rate hike, in anticipation of that rate hike, bonds dropped 10%. Long-term treasuries dropped just about 10%, in the months prior to that. But look what happened when the actual rate, the first rate hike actually happened. So that, which is represented by this blue line, over the next 1 year, bonds were actually up 6.33% after that first rate hike. And that's not an anomaly. Let's look at 2004, which is the next cycle of the first rate hike. So in the couple months leading up to that rate hike, same fund, long-term treasury bond fund, was down 5.6%. When the rate hike happened, after that first rate hike, bonds went up. I'm not looking at the yield. The bond price went up and had a return of 16.34% over that next 1 year. So again, bonds struggled in the year leading up to it, and especially a couple months leading up to that first rate hike, anticipating rates already going up. But then once the rate hike happened, bond prices actually started going up. And then let's look at the most recent one. So in December 16th of 2015 was the last interest rate hike cycle. And you can see here there is a drop of 9% in bond prices leading up to that first rate hike. But look what happened over the next 6 months after that first rate hike. Bond prices went up 19%. So now let's fast forward today. This is bond returns over like the last little more than a year leading up to the first rate hike. So bond prices, this long-term treasury bond fund, are down 17% leading up to the first rate hike. Remember, most likely that first rate hike will happen on the next Fed meeting, which is on March 16th. And that hasn't happened yet, obviously. So we don't know the future. But there is a high likelihood, at least if history repeats itself, that bond prices could go up after they start raising interest rates. So, while we have been underweight bonds, we actually just recently, within the last couple of weeks, adding a little bit back to bonds. Remember, prices have already dropped on bonds, so hopefully we're buying here at a lower point. And if history repeats itself, and the bonds have already factored in interest rates going up, then we can buy at a good point in time, and it can go up afterwards. This is also a protection too, usually during bad stock market events, especially when the economy starts to take a hit. Bond prices go up. So bonds can also protect your portfolio if we were to start going into a recession. So I hope all that helps, and we're able to really ease any fears you may have. Obviously, if you want to know about your specific account, or you have any questions, or if you still want to talk, just call up your advisor or shoot us an email, and we're happy to help you in any way we can. Hope this helps. Take care.